The review is based on forecasts from Goldman Sachs, J.P. Morgan, Morgan Stanley, Bank of America, the Federal Reserve, and other reputable sources as of January 2026. 2026 will be a transitional year for the American economy. After 3 years of strong growth in the stock markets and the fight against inflation, the United States will balance growth and stability. Artificial intelligence and government decisions will determine the economic fate of the world's largest economy. Leading analysts predict GDP growth of 2.2 to 2.6% in 2026. This is a solid figure, exceeding forecasts for most developed countries. What will drive the economy? Investment in artificial intelligence is becoming a major force. Companies plan to spend up to $3 trillion on data centers and technology infrastructure. Plus, a new government bill will add $100 billion in support for consumers and businesses. The year will be divided into two parts: slower growth in the first half due to high interest rates, and acceleration in the second thanks to government's stimulus. Inflation, a sticky issue. Inflation remains above the Fed's 2% target, hovering between 2.4 to 3% for the year. Three reasons why: Trump's tariffs, the highest since the 1930s, will add 1 to 1.5% to prices. Housing costs, rent and ownership continue to rise. Cost of utilities, up 3.5% due to high wages. The bottom line, 70% of Americans say the cost of living is unacceptable, even though wages are rising 3.2%. Federal Reserve, pause or cut. After 3 cuts in 2025, rates are now in the 3.5 to 3.75% range, forecast for 2026. The Fed is trapped. On the one hand, the cooling labor market requires rate cuts. On the other, inflation is still high. Consensus: only 1 to 2 0.25% cuts during the year, although some experts expect more. The main factor of uncertainty is the end of the term of Fed Chairman Jerome Powell in May 2026. For ordinary people, this means mortgage rates around 6%. High deposit rates will remain. Credit cards will remain expensive. Stock market, 4th year of growth in a row. S&P 500 shows impressive results, plus 25% in 2024 and plus 17.8% in 2025. 2026 forecasts, all 21 Bloomberg analysts expect growth. Average forecast, plus 9 to 12% optimists, Oppenheimer, Deutsche Bank, plus 17 to 18% conservatives, Bank of America, plus 3 to 4% growth drivers. Corporate earnings to grow 12 to 15%. Highest expectations since 2008. AI revolution continues. Tech giants lead expanding leadership. Growth will cover more sectors. Key risks: AI bubble may burst to high valuations, PE at 22 times. Excessive concentration in a few companies. History shows, after 3 years of plus 15%, the fourth often brings a drawdown of up to 14%. US dollar V-shaped trajectory. The dollar has had its worst year since 2017, falling 10%. What's next? Forecast: dramatic scenario in 2 acts. First half of 2026, fall to 94 points. Fed cuts rates economic slowdown. Second half of 2026, recovery to 99 to 100 points. Fiscal stimulus will work. Inflation will accelerate. Fed will stop cutting rates. Threat: BRICS countries are actively reducing the use of the dollar. Russia and China are already settled in national currencies by 90%. Real estate market, the Great Reset. After a 30-year low in sales in 2025, the market is ready for a reset. Home prices, moderate growth plus 1% to plus 4%, depending on the region. Biggest growth, Northeast and Midwest, up plus 7 to 10%. Decline, South and West, Austin, Phoenix, Las Vegas, up minus 10%. Mortgage rates will remain around 6 to 6.3%, better than in 2024 to 2025, but far from historic lows. Sales will increase 4 to 14% due to increased supply in the market, decreasing rates, life circumstances forcing people to sell. The good news: affordability is improving. Wages are growing faster than home prices for the first time since 2020. Interesting fact: New homes are now cheaper than second homes for the first time in decades. Labor market cooling continues. Unemployment will rise to 4.4 to 4.5% from a low of 3.4% in 2023. Job creation slowed to 50,000 to 70,000 per month, was 200,000 plus. Paradox, market shows mixed signals. Hiring slows, layoffs rise, but unemployment claims near record lows. Wages continue to grow 3.2%. Key trend, companies are increasingly looking at AI as a replacement for human labor. A period of jobless growth possible. Top risks for 2026: 1. AI bubble, $3 trillion in investment, but no guaranteed returns. Parallels to the 2000.com. 2. Political uncertainty, Fed leadership change in May. Political pressure on Fed independence, risk of government shutdown. 3. Trade wars, tariffs at highest levels since 1930s create business uncertainty. 4. Geopolitical shocks, military conflicts, cyber attacks, energy crisis. Anything can shake markets. Opportunities for investors, diversification. Time to move beyond tech giants, industrial companies, infrastructure, defense, financial institutions, mid-cap companies, undervalued. Fixed income becomes attractive at rates of 3.5 to 4%. For homebuyers, better to prepare in advance. Consider new homes with incentives from developers. Summary: 3 scenarios. Baseline 60% likely. GDP plus 2.2 to 2.6%. S&P 500 plus 9 to 14% inflation. 2.4 to 2.7%. Steady, predictable growth. Optimistic 25%. GDP plus 3% plus S&P 500 plus 17% plus A. I shows quick results. Fed aggressively cuts rates. Pessimistic 15%. Recession possible. Market correction minus 10% to minus 20%. I bubble bursts, geopolitical shocks. 2026 will be neither a boom nor a bust. It is a year of transition and adaptation as the economy seeks a new equilibrium. Key message: it is time to be smart, diversified, and ready for change. The American economy is showing resilience, but challenges require close monitoring. Remember, no forecast is a guarantee. The best strategy is to stay informed and adapt to change.